Sorry, Corey.
No problem. Wonderful.
Oh, gosh.
Well, perhaps if everything's good to go, I know there's many people here excited to listen to Ken talk and share some really important information. I've been lucky enough, Ken invited Citizen Advocacy to attend this webinar as well. Some of you may know Citizen Advocacy in Ottawa, some of you may not, so I thought I would just talk a little bit about who we are and some of the work that we do. So Citizen Advocacy is an organization based in Ottawa, but we support people all across Eastern Ontario. Do this through a variety of different programs. Our Everyday Champions matching program, where we match an individual living with disabilities to a volunteer advocate. We also have a Lifetime Networks program where we create a network and circle of support for an individual living with a disability, and also through our fetal alcohol resource program, where we help support families with FASD and individuals and offer some really important education to the community about that brain injury. People need people. We know this in our everyday lives, and we try to bring that towards the community writ large so that we can help citizens live inclusive and valued lives. But we also have my work. So I'm the Knowledge Transfer Coordinator at Citizen Advocacy. That's a great title, which I didn't choose for myself, but I love nonetheless. Basically means that I try to bring resources to families. I do this through different workshops across Eastern Ontario in both languages, but also by developing online resources. If you visit our page, which is citizenadvocacy.org, you'll find our Community Clips resource, which is basically our version of TEDx. It's our way of filming all of our conferences so that you can watch any resources you'd like about housing, system navigation, or family supports in a digestible way. You can watch, rewind, rewatch, whether you want to watch a full 2-hour video or if you want to watch short videos over a period of time. This is really just a way for citizen advocacy to create resources that families can actually use. Well, speaking about resources, we've been lucky enough to host Ken Pope at some of our events as well. And while citizen advocacy, always says that we don't endorse any legal services, I know Ken to be a wealth of knowledge and that he's going to give you all great information and accurate, up-to-date information that will really help you plan for your loved one living with a disability. So I'm going to pass it over to Ken so that he can share some important resources and information for you all, and I'll be diligently taking notes. Thanks.
Thank you, Corey.
Thanks very much, Corey. Okay, can everyone hear me there?
Yep.
Excellent. Well, I apologize again for the confusion. It was my fault. I pushed the wrong button, and Christiane tried to sort it out in time, but of course it was on my end, so it's difficult for her to do. Firstly, my law practice specializes in assisting families with kids with disabilities and special needs. And we do a variety of things, Henson trusts and tax credit recaptures and assistance with guardianships and dealing with inheritances and a variety of things. And so we'll come across a lot of those topics as we proceed. And I'll try to keep the presentation within the same time period and try to have everybody finished by 8:30. If you have questions, please do send them in. There's a link at the bottom. And because of the number of people taking part, of course, we won't be able to answer all the questions. But what we'll do is we will log all the questions and then do our best to reply later. And of course, you can always send me an email directly to kpope@kpopelaw.ca, and I'll be happy to respond directly. I've already received 10 or 12 of those types of questions in anticipation of the seminar. I'm having trouble moving this forward. There we go. It was just very.
Sorry, Ken. It looks like I have control now.
Oh, okay.
You just tell me where you want me to go.
Okay, just to the second slide.
Okay.
Is this the one? Is this the second slide? I think so.
Yeah.
So as those taking part can see, in Ontario, there are a phenomenal number of people on ODSP, and this is only the people between ages of 18 and 65, because when the children are younger, they're not on ODSP. And when they're 65 and older, they're senior citizens, and they receive old age security and guaranteed income supplements. But it's an amazing number, because you can see that if you take the population of the province and then divide that by 3, because StatsCan says that if you divide by 3, that tells you approximately how many households there are, which sort of seems to make sense, a couple and a child. So if we do that, you'll see that the population of 13.7 turns into 4,566,000 households. And then if you look at the number of people on ODSP and consider that it doesn't include kids under 18 or seniors over 65, this is approximately a third again. So it's pretty easy to see that this will be in the range of 456,000 households. So what this means is that approximately 1 household in 10 in Ontario is a parent household of a child with disabilities or special needs. 1 in 10. It's a phenomenal number. And then if you go to the next slide, you'll see that the people on ODSP, once they turn 18, will qualify for certain financial and medical supports. And what they receive, if they can't function in a competitive workplace or in the community or handle personal care. So this, as you'll see when we get later on to the disability tax credit, this is a lesser test than the disability tax credit. The monthly benefits are either $896, which is the room and board amount, or $1169, which is the shelter plus supplementary benefits. And when we get to the next slide, I'll discuss how to get that larger amount. On September 1st, 2017, the amount of the gifts from any source that can be received for somebody on benefits increased from 6,000 over 12 months to 10,000. Anyone who is concerned because they've been giving their child money and it's going into an account and therefore is potentially traceable or trackable, because of course most people just give their child a certain amount of cash every so often. The test is now 10,000 over 12 months, not annually, which is something greater than 800 a month, which is more, I think, than most people do give to their child if they give them that much. But it also deals with, payments, if it was ever called to account, with payments for any other amounts paid to third parties. And the asset test, which used to be very tight, is what used to be $5,000 is now $40,000 per person. And there are further allowed amounts for the asset test if you happen to have a benefit unit with a spouse or with children. The other thing that is new is it used to be that if you were injured in some way, motor vehicle accident, personal injury, the first 100,000 of the settlement was exempt, but now it's fully exempt. All of the tort amount for the pain and suffering is exempt, and in practice, the amounts under the statutory accident benefits, which includes such things as, not income replacement. If there's income replacement, that would affect ODSP. But medical coverage, transportation services, housekeeping, all of those things are quite possibly exemptable, and in practice they would be exempt. You still have to deal with them as if they aren't and request exemption, but in practice they will be exempted. So if you're lucky enough to be on ODSP and injured and then on ODSP, the settlement amounts are largely exempt. This is, I think, particularly of interest to anyone who before, this was done August 1st, 2017, anyone who before that date found themselves disqualified because of this settlement should now be able to re-qualify if they medically qualify and not be disqualified because they have this financial asset. So if you know anyone who was injured and disqualified prior to August 1st, 2017, they should reapply for ODSP if they are still medically likely to qualify. Okay, next slide. So you can see here that the room and board amount is $896 and the shelter plus supplementary is $1169. And there are, of the number of people on ODSP, 13% are living with family, which is approximately 45,000 of them, of the 360,000. And those 45,000 are all going to initially be on the lesser amount. So what we do on a regular basis is we get it increased to $1169. And I'll tell you how this is done. You can try it yourself if you wish, but I'll have to also discuss here the downside of trying yourself and failing, because that makes it much harder for me to fix it later. What we do is we set up a lease, and it looks very official. It is official. And it's a lease between the parent and the child. And we typically have the quote-unquote rental amount as being $500 or $550. It's presently $496, in fact. But of course, every couple of years, there's a very small increase. And what we found over the last couple of decades is that if you just were to slot it into, let's say, $500 a month, then in a few years, the amount that is allowed is slightly more, but you will, of course, continue to receive the 500. So I suggest you make it 550. Now, the ODSP office that you deal with will push back. What they'll do is they'll try to call and speak to the child to ask the child whether they do their own shopping and cooking, which, of course, in practice they don't. But they may well be able to. And of course, as a life skill, this would be a good thing for them to learn how to do, and everyone supports this, of course. But they would call and try to speak to the child and get the child to say, no, I don't. Or to speak to the mother in most cases. And of course, mom does typically make most of the meals for the family. This doesn't change the fact that if the child could shop or cook, or if you were to pay someone else to shop or cook, or if the child is on a gastro tube and uses formula to feed themselves, or is on a by their own choice in some cases, is on a restricted liquid diet, and they drink the liquid that supports them, well, then the parent is not providing the food. That qualifies. And similarly, if they're in supported living and all of their food is provided, the organization that provides all the food, in this case, they get the higher amount. It's only the parents who get the lesser amount, which I think is somewhat unfair. So we do the lease arrangement. If you try it, well, you're welcome to try it, of course, obviously. If you do try it, the problem is that if there's slippage and ODSP then says no to the benefit increase, once it's on the file, it's very hard for me to correct it. I think it's fair to say that there is some advantage to letterhead, legal letterhead, knowing what to say, presenting the material in a certain way with a story about the child. You know, so it's really a question of whether you would like assistance with it. ODSP also comes back with stories, and I'll just give you a few of them so that you know they're not true. That the child has to have a self-contained dwelling unit, which is obviously not true because people live in rooming houses. Or you say, well, yes, he does. I fitted out the basement. He's got a kitchen down there. He's got a bathroom. The standard response to that is, oh, well, did you tell the city? As in, you know, did you get a permit for this? You know, and of course, if it's for a family member, there's certain exemptions for those kinds of renovations. Or they say, well, you know, if you show us that you're reporting the income, which of course is contrary to the whole purpose, because if you're reporting $550 of extra income and paying tax on it, it's pretty counterproductive. Well, you're not supposed to declare this as rental income. And of course, we provide you with material from Canada Revenue about this. And the short story is that if you're not in pursuit of profit, well, then you are not supposed to declare this as rental income. And similarly, you can't write off expenses. Now, if you happen to be one of the families that has been charging the higher amount and is getting the higher amount, and that you have a tax filer who has advised you to take expenses equivalent to the rent, and you wish to just continue to do this, well, I have nothing really to say about that. But there's no question that that you're not really supposed to declare it as rental income. As far as exempting assets, firstly, if a person is on CPP disability, well, then medically the test for that is higher than the test for ODSP, because it means you can't work at all, which means you obviously can't function in a workplace at all, not just a competitive workplace. So this means that if you have, for example, been approved for CPP because you were a worker and contributing in 4 of the last 6 years, then you receive CPP disability benefits, but they're always less than ODSP, and they don't come with drug and dental. So you could then simply prove that you're receiving CPP disability, and medically, you would be automatically approved for ODSP. But by definition, you're a worker, and if you have assets saved, then prior to 2017, if you had more than $5,000, you couldn't qualify. Now it's $40,000, but I suspect that there are lots of new CPP disability benefit recipients who have more than $40,000, and therefore, on the face of it, would be disqualified from ODSP. So suppose you had an RRSP with $80,000 or $120,000. Well, of course, that would disqualify you on the face of it, but we have ways of exempting up to another 100,000, so 140 in total, and getting somebody onto ODSP. And what would happen is you would be topped up to 1169. So if you happen to be getting, let's say, $700 CPP disability, you would then get an additional $469 plus drug and dental coverage. If you happen to know anybody who's in that situation, you should tell them, obviously.
There's a few questions related to ODSP, if you feel like taking them. One of them, David's asking, is it necessary to report ODSP every year, the payments that the family member receives from the Henson Trust?
Well, from the Henson Trust.
Yes.
Yes, there's an annual reporting from any trust fund or any source of funds like this that is directly attached to the ODSP recipient. And so, yes, there would be an annual report. And the basic simplistic rule, which initially misleads a lot of people, is that they can only receive, under the new rules, up to $10,000 over 12 months. But in practice, what happens is there really is no limitation. It's true that the individual benefit recipient is supposed to only receive $10,000 over 12 months. And if they received more within that 12-month period, then there would be a dollar for dollar offset against ODSP, which is, of course, useless. But what happens is that the trustee of the trust makes a calculation either annually to provide annually or perhaps over a 2-year period or however long a period that the trustee wants to calculate. And what you do in a given month is the trustee pays out from the trust a sizable amount, let's say $20,000. So in addition to the $10,000 over 12 months, $20,000. So the trustee pays out, let's just say, in the month of January. And when this is reported at the end of the fall of that year, it will be deemed to be an overpayment to the benefit recipient. 10,000 is fine, but the 20 is an overpayment in the month received. It's income in the month received. So they have been overpaid that 1 month. It's reported 12 months later, and the overpayment is recorded. There's no other effect. There's no loss of medical coverage. There's nothing else has changed. But the, let's say, 1169, which was paid that month, is deemed to be an overpayment in the month of January. So what they do is they claw back the 1169 at the rate of $50 a month, potentially forever if you do this every year. But the $50 never changes. And the $20,000 could be dispersed. And what would happen, for example, is suppose the parents are deceased and the child is now living in his own apartment. He receives approximately $500 for the shelter component of ODSP, and he needs $1,200. He's $700 short, for his rent. So what the trustee does is he calculates $700 a month times 12 or 24 or 36, and he disperses in the month of January $8,400, and he gives it to the property manager for the apartment and has the property manager offset $700 a month over the next 12 months or 24 month or 36 month period, and everything's good. So for example, that would be $8,400. So we've got a few dollars left in the 20,000. So perhaps every year there's going to be a trip to Cuba. Well, in the month of January, the trustee would pay for the trip to Cuba, the 2-week all-inclusive. What else? Car payments. It could be, for example, insurance on the car or the car lease payments. Say the lease payments are $350 a month times 12 or 24 or 36. So the trustee could disperse these lump sums, and the only offset is in the single month in which the money is deemed to be income in the month received and resulting in a $50 a month reduction. And of course, you're already giving the child, let's just say $800 a month, which is $9,600 of the $10,000 over 12 months. Are there any questions about that? Okay, let's try the next slide. The disability tax credit. If a person who has a disability is markedly restricted or takes substantially longer to do things, or can't set and keep goals, or needs constant supervision in a cognitive situation, or of course has several of the other physical disabilities such as mobility, walking, talking, elimination, feeding, those sorts of things. Well, if they qualify for the disability tax credit, then they can have an RDSP, a Registered Disability Savings Plan. And what we find in the most common profile is we find that the credit should be applied and was never applied, or it used to be used, but when the child went to live in supported living or perhaps on their own, that the parent stopped using the credit because it was being transferred to the credit, to the parent, because they thought the child had to live with them. So the most common profile is a situation, and I would say this is in about a third of all of our files actually, that the child should qualify or did qualify for the disability credit, but it's not presently being used or was never used. So what we do is we have the T2201 forms completed by a doctor. They're submitted to Canada Revenue. They're approved. You have to track the process because in a certain number of these cases, the doctor receives a follow-up letter asking for further information and often either doesn't complete it, which stops the whole process, or they do complete it, but on the form that is on CRA letterhead, at the place where the doctor signs, it says it is a serious offense to make a false statement. So of course this sets the doctor back, and of course he's a professional and wants to be conservative. So in the letter, it's normally options for the types of disabilities and then A, B, C. A, no problem. Well, of course, if that was the case, why would we have sent it in? B, yes, but not all the time, only episodic or in crisis. And then C is yes, serious market restriction all the time. So when the doctor becomes a little shaken up about the process here, what they do is they look at it, they back step, and they select the B, which means that yes, it's serious, they don't doubt that, but it's not continuous. Well, of course, that's the end of that story because it has to be continuous. Now, when we follow the process here, we make sure that these forms are completed and done correctly and not submitted if they're not, and so on. And the standard recapture these days, backdating the credits 10 years, because that's the maximum period, is usually about $18,000. So that's the disability credit, which would be on line, in most cases, line 318. The transfer from the child to the parent who pays taxes is on line 318. We do try to pay attention to the parents to see if the parents also, if they're elderly, for example, or happen to have scoliosis or happen to have illnesses, diabetes themselves, sometimes we're also able to get them approved, and that's a good thing as well, of course. Now, there's a lot more slides about RDSPs. We'll get to those in a second.
There were some more questions about ODSP. It's hard to navigate. I was muted. I was trying to tell you, but we moved on. Do you mind taking a couple of ODSP questions?
Sure, go ahead.
Okay. One of them is on ODSP, and their father is a retired teacher. He's wondering, after both parents pass away, will he be able to get 50% of the pension?
Of the father's teacher's pension?
Yes.
Yes, okay, so the person asking the question is aware of that. There are provincial statutory pensions for teachers, municipal employees, and hydro generator, Bruce Nuclear, and anyone who qualifies for a statutory provincial pension like this. If they have an adult dependent survivor, such as the child with disabilities, if they are dependent at the time that the parent dies or the second parent dies, they stand to qualify for 50% of the original pensioner's pension. So if it's a teacher and the pension is $60,000, which wouldn't be unusual, and there's an adult dependent survivor child who is dependent at the time of the teacher's death, then they would qualify for $30,000. So yes, if the question here, excuse me, is would this person qualify? If they are an adult dependent survivor, then yes, they should qualify. And yes, of course, they would then lose ODSP because the 30,000 is greater than ODSP, amounts to something greater than 13,000 a year. And the pension would have to come to the person directly. It's not something that the most common misconception is that somehow this pension could be left to the Henson Trust for the child, along with the estate, the share of the estate that is going to the trust for the child. It has to go to the person, the child, the adult child. And that means that there's the question, and in this case, this person asking obviously cognitively can ask this question, so they must be reasonably competent. But the question then is, what if the child is not competent? Suppose it's a cognitively disabled child who has lived all his life with his mom and dad. Mom and dad were both teachers. That's not uncommon. They both have $60,000 pensions. And when they die, the second of them dies, he gets half of two pensions, $30,000 each, $60,000. But is he competent, firstly, to apply to get the pension, and then secondly, to manage it? So you then get into the question of competence, mental capacity, powers of attorney, legal guardianship, because what would be needed in anticipation of this sizable pension is that someone be in a situation where there's a lack of competence, someone's legal guardian, because you have to have a legal representative to apply to get the pension and then to manage the pension. Got another question for me?
Yeah, if you're on ODSP and turn 65, are you still covered for drug benefits?
Well, you're a senior, and all seniors are covered for drug benefits. Ontario Drug Benefit Program. So you wouldn't need to have it under ODSP. I'm trying to deal with the concern first rather than the legalities of it. And ODSP continues and does not simply cease at age 65 until you apply for and receive replacement income, old age security, and guaranteed income supplements, and possibly Canada Pension. So what happens is, approaching age 65, you would apply for old age security and guaranteed income supplements. And the reason you would do this is that ODSP is approximately $13,800 a year, and OAS GIS is $17,400. So it's more money. It's almost $4,000 more a year. And your drugs are covered under the Ontario Drug Benefit Program. So you're good.
There's another question. Is there a percentage that matters in regards to the shopping and cooking for qualifying for rental versus room and board?
I mean, how much a person can shop and cook?
Yeah, like if they did it 50% of the time, would they qualify?
Well, that's really not a criteria. Technically speaking, what's supposed to happen is they're supposed to do their own shopping and cooking, and the reason we do the lease is to try to break out the nature of the relationship between the parent and child, to make it a landlord-tenant relationship, because in a landlord-tenant relationship, food is not provided, right? That breaks the room and board unity. As to the amount of actually shopping and cooking, no, because of course most people who live with family, which is the scenario here, it's a question of, could you shop and cook if you wanted to? Because of course most of the time your mom, your parents are still going to make the food, and they're probably going to go with you, and you're going to all shop together, and you don't have to even, you can be enumerate, you don't have to be able to make change. You go, and if you can punch in the four number PIN code and use a card to pay at an honest grocery store, which they are, well, you're paying at the checkout. And I go through a process of asking people, well, you say your child can't shop and cook. Let's talk about that. If you go to the grocery store, your child comes with you. If they have a shopping list, can they read the shopping list, and can they put those items in the cart? Oh, no, he can't read. Well, suppose that the shopping list was made with pictures of all of these items, because of course pictograms are a common adaptation. Oh yes, he can pick them out, and he knows what he likes. No, he likes this and that, and in fact he's a vegetarian. So yes, he can shop and he can put the stuff in the cart. He can go to the checkout, he can pay for it, he can take it home. And I ask, well, when you get home, does he know to put the frozen things in the freezer? Oh yes, he can tell what's cold. He can stick that in the freezer. And okay, so now he has all this food at home, and we've got the things that he likes. Can he cook it? Well, we don't trust him to use the electric stove. And then we have a short discussion about the fact that you can get electric burner overrides that will allow something to be heated up to boil water, but not sufficiently to make oil burn. And of course that would be probably useful for a lot of landlords to make sure that when people come home from Hull and make French fries, they don't burn the place down. But I got that piece of it from a friend of mine who's a landlord-tenant lawyer. But oh yes, he can put things in the microwave. Well, you told me that he's enumerate. He doesn't know how many minutes. Oh, well, no, that's okay. He knows 4. He knows 400. He can do it for 4 minutes. Or we can put a little star on the ones that he's supposed to push. He can heat it up in the microwave, not a problem. So when he comes right down to it, that child can shop and cook. It was more a matter of the family, of course, for good reasons over the decades, because now the child's 26, just never doing it. And this is a good thing. Life skills are a good thing. Any questions about that?
No.
Okay. Because I was prepared to invest time into this benefit increase aspect, because that's one of the most important things for 13% of the families. Second one is the tax credits, the recapture of the disability credit. Is this the, click to the next slide. It's the one that has the caregiver on it.
Yeah.
So you can see here as well that there's a second credit called the caregiver tax credit. And if your child is 18 or older, has a disability of some sort, and up to the end of 2016 resided with you, and I'll get into the change in a second, resided with you and had income at that time of less than 17,000, which they do, well then you qualify, the mom and dad, for the caregiver tax credit. Now it's only from 18 on, but it's kind of convenient because when the child is under 18, the disability tax credit reduces your taxes by $2,200 a year. And then when they turn 18, it's reduced to $1,600 or $1,700 a year. But then if the child's living with you, the caregiver credit increases it by 1,000. So you're back to $2,600 or $2,700 a year. So this is all good. Now, we regularly backfile these, and because in earlier years the recapture per year was less, it's now 1,000 a year. It's not a round number for 10 years. It's not 10,000. It's slightly less until the 10 years have elapsed. But again, it's a very, very common recapture for us. And in 2017, the criteria that the child had to reside with you was removed. Now, the neat thing for me is that there are approximately 360,000 households with a child, an adult child over 18, who is on ODSP. Now, we know that in almost all of those cases, the parents do help that child. They are caregivers in some way, even in modest ways, although there are granted a few where the child is completely capable or completely estranged. Yes, I realize that. But in most cases, these families, every family tries to provide for the children. And until 2017, the child had to live with them. So that meant it was 45,000 of 360,000. What's now happened is, as of 2017, I suspect it's like 99% of the 360,000 who would qualify, and of course they don't know. So you could recapture 2017. If you haven't filed your 2018 yet, you can use line 307 and a Schedule 5. And potentially what this, if we can just get the word out, what this means is that one day, up to 360,000 households will be using this credit, and it'll be reducing their taxes by $1,000 a year. That's 360,000. I think this is great. Are there any questions about that?
Yeah, there's more. Can the caregiver credit be claimed on behalf of a deceased parent?
Deceased parent?
Yeah.
No.
Like, can we claim it against a deceased parent?
Oh, yes, we do that all the time. If you have a parent who has passed on and you learn about these credits and you think, oh my, we should have used those, yes, as long as you don't have a tax clearance certificate, you haven't closed the door on the estate, we regularly go back and recapture, 16 or 17,000 for the disability credit and another 8,000 for the caregiver credit. So you're on behalf of the estate, you're bringing in another $23,000 or $24,000. And I think it's incumbent on the executor, if they learn about this, to do it. I mean, how can you say no to $24,000? It's your job to bring in the estate.
Yeah. Someone else is asking, does the child's income matter in regards to claiming the caregiver credit?
Yes, under the new rules, it used to be 17,000 and over would affect the caregiver credit on the part of the parent, and now it's 22,000 and over. So yes, what I'm seeing here is, well, what if the child is working and on ODSP? So yes, that could affect the situation. And what it would do is it would simply erode the total amount. The 1,000 a year would be reduced depending upon how high the income was.
Both my son and I are on ODSP. Do I qualify for the caregiver credit?
You have to pay taxes to get it back. Next slide.
Yeah.
So if you're approved for the disability credit, the child can have a registered disability savings plan. Now, the RDSP may be managed by a parent if the child is not competent, an adult child. A minor, of course, the parent always manages the account. But the important distinction is to realize that the RDSP is the property of the child. It's not like an RESP where it's actually, and people may not click to this either, but it's not actually the property of the parent. So the RDSP belongs to the child, and if you set it up after the child's 18, subject to their household income, which is ODSP, not your household income, then if you do nothing, they'll get $1,000 a year as a bond for 20 years. And if you contribute $1,500 a year, they'll get a further $3,500 a year. So for $1,500 and $4,500. This is all good. And this can go on for 20 years. In the case of our getting a recent disability tax credit approval back for 10 years, there are arrangements to make retroactive contributions if you wish. You would do that kind of thing, once you get your $16,000 or $23,000 back from Canada Revenue, $23,000. you could then make retroactive contributions. But you would normally only do that if the child is in their 30s or 40s, because the grants and bonds are only available until the 49th birthday. So if the child is 22 and you're going to contribute for 20 years at the rate of $1,500 a year, well, you would normally just go forward. You wouldn't bother going back. But if the child happens to be 42, well, you've only got 7 years left. So then you would certainly seriously consider buying back into the last 10 years. That would give you 10 plus 7. That's pretty close to 20. Now, just to give you some scope on this, if you set one of these up when the child is 18, you contribute $1,500 a year, you get 30. You contribute $30,000 over 20 years. The government puts in 4,500 times 20. That's 90. So 30 plus 90, 120. If the money was invested at 5%, at the end of the 20 years, it's approximately $200,000. That would make the child 38. Now, of course, the grants and bonds are not locked in until 10 years later. So that's 48. And at that point, you could contemplate taking money out. And of course, if you've waited a further 10 years, the $200,000 invested at 5% is $300,000. And that's at age 48. If you simply hold on to it until 58 or 60, it's $400,000. This is a substantial asset. This has never happened before. It's only been the last 10 years. The Harper government brought this in. And in the current budget, the Liberal administration said that what it's going to do, commencing in 2020, is if a person loses their disability credit approval at a certain point, instead of you being obliged to collapse the RDSP and give back all the grants and bonds that haven't vested, as in less than 10 years, they've decided that if you lose the disability credit, you no longer have to collapse the RDSP, you can keep it. So whatever you've contributed, whatever the government has contributed is there, and then you still have to wait 10 years for it all to be vested, but at least you don't have to give it all back. And since this was brought in by the Harper government, and this proposal improvement is being brought in by the Liberal government, I suspect that in October, if the Conservative government is elected, that it won't change. I can't see that changing. Any questions about that?
Yeah, someone's asking, how do I apply for an RDSP?
Well, you could do it at any bank, but I would advise you instead to deal with some investment firm because the banks don't typically give you investment advice. And on a regular basis, I see RDSPs that are 10 years old. The parents have made all the contributions. There's approximately $60,000 in it, grants and bonds and contributions, and that's all.
Yeah.
So you don't get much advice from banks, and it's all on a call center. If you deal with any financial investment firm, Investors Group, IPC, and any investment firm, then they'll set you up with an RDSP, either one of their in-house ones, such as Investors Group, or Mackenzie Financial if you're with IPC or whomever you deal with, and you'll actually get some investment advice.
Peter's asking, can I contribute to my own RDSP if I'm eligible for the DTC and over 18? And as a follow-up question, can somebody contribute after the age 49?
Well, you certainly can if you're capable. Set up your own RDSP. That's not a problem. You can contemplate that someone might be working for the federal government. They're in a wheelchair. They qualify for the RDSP, and they're under 49. So they would certainly manage their own RDSP. After age 49, people can contribute. And let's just say that you have contributed the $30,000 to get the maximum grants and bonds, or you want to leave that room. Well, then you can contribute up to another $170,000. But you have to keep in mind that you won't be able to access it until you've ceased making other contributions and then waited 10 years or you'll lose grants and bonds. You can't just take your money out. If you over contribute and pay, say, $170,000, you don't get to access that money. If you take any of it out, you start to lose grants and bonds. So it's more of a long-term investment. But yes, you can contribute up to age 59.
Chris is asking, does an RESP or RDSP count against assets for ODSP?
No, they're actually both exempt.
Cool.
Next slide. So this just gives you the breakdown of all those contributions. Next slide. This is just more individual. These slides are, we'll be sending you these PowerPoints, and they just lay out the answers to some of these questions. Next slide. Yeah, I'll just give you a second to read this, but we'll be sending them to you anyway.
Would it be beneficial to have the RDSP primary owner using both parents' names or just one?
Doesn't matter. The forms typically only have two slots, but there is in fact no real restriction to the number of account holders that you can have. And I would suggest that if the child is competent and wanting to learn, they're presently financially unsophisticated, as most people would be, and you want to have both parents helping, and then if one of them passes on, the survivor helping, then that would be the way to go, with both parents plus the person. Next slide, please. Okay, so let's talk about legal guardianship, powers of attorney, substitute decision makers, and trustees. There's a lot of general confusion around these topics and what they do and when they come into play. Firstly, I'll just slice off the trustee part. The trustee doesn't come into effect until the parents have passed on, their will has a Henson trust in it, and the trustee is managing the trust. And they only manage the trust fund. Substitute decision maker, that's only as to personal care. And under legislation, if there is no power of attorney, because the child's not competent to sign a power of attorney, and there is no legal guardianship because no one has applied to the court to be appointed the legal guardian, then purely for personal care, there is this hierarchy of who is the substitute decision maker. And it is, to be simple, firstly the parents and then siblings. Now, obviously, if the person was married, the spouse would fit in there as well, but most people are not married. And then, if a person is competent to sign powers of attorney, this is a revocable way to appoint someone to be their attorney for property and personal care, to help them with their decisions, to be free to be given information, this sort of thing. And then finally, if the child is not competent, let's say they're over 18, they're not competent. The reason we started doing guardianships back in 2009 was that at the time, there was no provision for the parents to automatically be the account holders if the child was not capable. So at the time, the only way to have an RDSP and not miss out on the grants and bonds if the child, your child, was incapable, was to have legal guardianship. And then a few years later, the rules were changed to allow this automatically. The problem now is that there's no provision to go past that. What happens when the parents die? It's not automatically a sibling if there is a sibling. And of course, families get smaller all the time. So the legal guardianships that we do are primarily to deal with who will manage this sizable RDSP after the parents are gone, and who will manage the pension, the adult dependent survivor pension left to them by their parent. The interesting thing is that if you're not competent and there is legal guardianship, the legal guardianship is like a power of attorney in the sense that it ceases, it ends when you die, just like a power of attorney. You sign a power of attorney, you die, it's over. It doesn't carry on, you can't manage the estate. you would then, in these cases, if you're dealing with $300,000 or $400,000, you're looking at probate applications just like any other estate. And the interesting thing is that if you can't do a will, if you're not competent, you can't do a will, and the guardian can't do a will for you any more than a person with the power of attorney could do a will for you. So this means that you pass on with $400,000 and succession law kicks in. There's an intestacy because there's no will, and then succession law kicks in. Now, if your parents had survived you, they would receive your estate, but of course they typically wouldn't. It would then, there's a tree, a succession law tree. It would then go to your siblings, if any. Failing that, to their children, if any. But failing that, it goes up the line to aunts and uncles. And then if they're predeceased, because your parents were the youngest of their siblings, so the aunts and uncles are all gone too, it then goes over to the side and drops down to your cousins, who you hardly know and don't live in Canada, and who have never come to visit you, which I think is fascinating. And the aspect of the adult dependent survivor as well. If you're, in a supported living environment and your needs are modest, and you have a $30,000 pension, well, you're not going to be able to spend all of it. And your legal guardian who has applied for it and is managing it and investing it, they couldn't spend it all on you either appropriately. So at the end of the day, the end of your day, it will largely have accumulated, and then you'll die without a will, so it's intestacy, and then by succession law, somebody gets it, which is often the sibling who is the legal guardian after the parents are gone. But this kind of thing, it's only been 10 years that this has been a possibility. Now, for the RDSPs, pensions are slightly longer than that, but relatively few of the teachers and municipal employees and hydro workers have passed on. My experience is that they are largely unaware of these pensions. We do our best every day to spread the word, and if you know anybody, tell them. With respect to the OMERS pensions, municipal employees, municipal employee pensions are generally quite a lot less than teachers and hydro workers, and they act only, for example, $500 a month. They act only to offset ODSP. So I'm still looking for the opportunity to find a way, and I haven't found the opportunity yet, to see if I can commute the OMERS pension of $6,000 a year into a lump sum and waive the pension, which would simply offset ODSP, and then exempt the lump sum. I think that a client would be better off to receive a lump sum of $50,000 or $100,000 rather than receive $500 a month, which simply offsets ODSP. Seems pretty no-brainer to me, but I haven't found the right scenario to do that just yet. I'm looking for it. Next slide.
Yeah, there's a couple questions. They're kind of related, so I'll pose them both at the same time. One person asked, is guardianship necessary if I'm the parent? And someone else asked, what age should I think about getting POAs for their disabled child?
Well, the power of attorney first. Powers of attorney for personal care are effective at age 16 if the child is competent, and at age 18 for property. And it's much less expensive than legal guardianship. And as long as you're content that if these are prepared, that the people you deal with, even if they meet your child, are prepared to hang their hat on these powers of attorney, then that obviously from a practical perspective, that's the thing to do. And I've known people who have their child sign hand over hand to deal with the simplistic things that otherwise are an aggravation. As far as the legal guardianship, that would come into effect at age 18. And it's not really of much advantage to the parents, because the parents are already the ODSP trustee. There's never any problem with that. And they're already the account holders for the RDSP. It's for the succession when the parents are deceased, who will then take over. It could certainly be the same person who is the trustee of the Henson Trust. It doesn't have to be, of course. Might be better to have somebody separate. But the issue is what happens when the parents die. And in my experience, what happens is, and rarely, the parents, obviously, I've made them aware of the whole scenario, and rarely they wait and they say, well, that's up to my trustee to fund that. I can't afford it right now. Because it's, thousands of dollars. We don't try to sell it. We simply do it if it's needed. My fees have been the same for 10 years, but it's still a burden. And it's that succession arrangement. Who takes over to manage things when the parents are gone? Most parents in these scenarios, if this is a concern to them, they arrange this so that they are guardians along with a successor guardian, sibling most often, and that's done now rather than later, even though the parents themselves don't really have to do it.
Next slide.
Yep, please. So this deals again with the pensions for adult dependent children. Next slide. So that brings us to wills and Henson trusts, lifetime benefits trusts, and funding trusts with life insurance. And a share of an estate that is to go to help provide for a child on ODSP would normally go to a Henson trust, which is written into the will. The trust does not exist prior to 1 or 2 deaths. It typically kicks in after a death, typically after the second death, to receive the share of the estate that is to go for that child. Sometimes it's all of the estate, sometimes it's an equal share, sometimes it's slightly disproportionate, but that doesn't take effect until someone has passed on. There's a common misconception, just as there's a common misconception that the trust can only have 100,000, or it can only disperse 10,000 over 12 months. Neither of those is true. The amount of the Henson Trust Fund is unlimited, and in practice, there's no real restriction on how much can be dispersed. We've already had the discussion about the 10,000 over 12 months. The trust itself also has provisions. It has a residue clause, and so your will determines where the residue of the trust goes when the beneficiary has passed on, decades after you've died. And of course, logically, it's to their children, if any, but failing that, to their siblings, if any, failing that, to their children, if any. And then from there, you get into the discussion about, okay, well, there's none of those, what do I do now? But that's just part of the standard process. The Lifetime Benefits Trust is a relatively new vehicle. It's not well known at all. And it's specifically designed to have one benefit recipient, one beneficiary, sorry. Now you can have more. Oh, sorry, that's QDTs. It's designed to have one beneficiary, and the primary purpose of it is to receive registered funds, RRSPs and RIFs. And the example is on the next page, I think. Can you find the calculations for the? Keep going.
This one or the next one?
Yeah, go to back to the 275. This one. Go back one more. Okay, so you can see here that there would be lots of parents where when the second parent passes on, that has a $275,000 RIF. Very common. So upon the first death, of course, it rolls over to the surviving spouse. But then, if the second parent dies and it falls into the estate, in most cases, this is again slightly simplistic, but you can see that depending upon whether you die in January or December and what your other income is, it's going to be taxed at approximately 50%. So for our explanation purposes, we take it as $137,500. Well, this is highway robbery as far as I'm concerned. The whole point is that people were told all their lives that if you stick money into your RRSP and keep it there as long as possible, that you'll save money, you'll save taxes, it'll accumulate, it'll grow. And then the presumption, of course, is that when you take it out, that you're in a lower tax bracket than you were when you started, which in lots of cases, that's not true, right? It could be true, nominally. But when you have a situation where there's a second spouse, a surviving spouse, who has a reasonably sized RIF, this one's 275. The next example is 500,000. That's also very common. Then, depending on what time of year they die, if they have other adequate income, such as a teacher's pension. Now, granted, a lot of teachers don't have RRSPs because they have defined benefit pension plans. But suppose you had adequate other income, what you would find is that the amount of money that comes out of the RIF each year that you must declare as income, that in the early years at least, that if the money is properly invested, that it continues to grow or stay stable, even though you're withdrawing funds. So when you do eventually pass on, it's still a sizable amount. Now, if instead you designate it to a lifetime benefits trust, and if your child has cognitive disabilities, they have to have cognitive disabilities, not just be in a wheelchair. So they have cognitive disabilities. And of course, this again brings us to the question of legal guardianship, because someone has to consent to the rollover of this RIF on behalf of the beneficiary. So it has to be either themselves or someone with their power of attorney or their legal guardian. But what happens is it rolls over just like it would to a spouse. The trustee of the trust receives it, and the only thing they can do is buy a qualifying trust annuity, which is an annuity based upon the expected lifespan of the beneficiary, the child. So what it then does is it pays a certain amount per month, per year, for the expected lifespan of that child. And of course, you can get a qualified annuity so that it's underwritten if they happen to be expected to live a lesser lifespan. But that's a small point. So what would happen, as you can see in the example, is it would pay $13,200 per year. Well, the child, this has to, well, Christiane, I'll have to slightly update this.
Okay.
See, the basic amount in 2019 is now $12,000.
Oh, okay.
But you can see that if a person has a personal tax credit of $12,000 and the disability tax credit of $8,400, roughly $20,000, then the $13,200 a year that the pension annuity pays is covered by the tax credits, and there's no tax owing. So you can see, once you realize how this vehicle works, that you have the choice of dying and paying tax of approximately half of the balance remaining in your RIF, or having it all set up in an annuity for your child, which would certainly satisfy the fixed income component of an investment strategy, because of course it's working in conjunction and side by side with the Henson Trust, which receives the estate. And there would be no tax owing. Could you go to the next slide with the 500,000?
Yeah.
So you can see again here, 500,000, taxes 250, 24,864 a year. And yes, there is a small amount of taxable income. And what we do is, what I found was fascinating to me, because psychologically, the people that you're dealing with that have adequate other income plus some reasonably sized RIF, unless you can guarantee them that if they know they're going to die and they know they're going to lose half the taxes, but they don't care, unless you can guarantee them that if they die and then the child dies soon after, that the annuity doesn't end. So what we do as a standard procedure is we see how much you're buying into it. So in this case, 500,000. How much does it pay per year? 24,864. And then you find out how many years you want to have guarantee on that it will continue to pay even if the child dies shortly after you do, because you get all your money back. And that's where the estimation of the tax is owing. If you have $4,864 of taxable income, and the taxes at 22% would be $1,070 times 20 years. That's how that number is determined. Now, of course, if the child lives longer than the 20 years, it continues to pay for their lifespan. So of course, in that calculation, the taxes happily would be higher.
Question, can you have a lifetime benefits trust for a person without a disability?
They have to be cognitively impaired.
Okay. I have some questions about Henson Trust that there's a few that are related. Can you collapse a matured RDSP into a Henson Trust?
Say that again?
Can you collapse or transfer a matured RDSP, and by that they mean like the 10 years vested, into a Henson Trust?
No, no. This is a common confusion. The RDSP belongs to the child. So when you die and you set up a Henson Trust, he's still alive. And he can't contribute it to the trust. Now, granted, when he's 60, if there was some special reason, maybe we can talk. You know, I don't know why you would want to contribute your RDSP to a Henson Trust. But, you know, we can talk when the child is, when everything's locked in. But I would say the simple answer is no.
Similar kind of question is, can you merge two Henson Trusts into one?
You could do. Yeah, you could pour over from one into the other.
Okay.
You know, and if you have set up a grandparent trust with the inheritance from the inheritance from a grandparent that would otherwise go to the parent of a child with disabilities, right? His share of their estate, the grandparent's estate. You could have a trust, a Henson Trust, in the grandparent's will to receive all of their child's inheritance, 1/3, let's say. And you could have it set up so that the child, instead of receiving their 1/3 directly, that they become the trustee of a Henson Trust in their parents' will, and the beneficiaries of that trust would be themselves, because it's their inheritance, and their child. You could do that. We do that every so often. And it's certainly something to look at, because if you receive an inheritance from your parent and you have a child with disabilities, if you receive $200,000, you invest it, you pay tax on the income. Whereas if you set up a trust in your parents' will for your inheritance, and you're the trustee, and you're a beneficiary along with your child, well, then you can attribute the income to your child. And they have $20,000 of tax credits. And by the way, this money, which is held in this Henson Trust from your parent, if you happen to divorce, well, it's simply not divisible with your spouse. It's worth thinking about.
Back to lifetime benefits trusts, how is cognitive impairment determined?
Well, are they cognitively impaired? You'd have an assessment. And in most of these cases, of course, you're going to find that the child is approved for the disability credit.
Okay.
Now, I think the next slide is the one about funding trusts with life insurance. Oh, well, I can touch this first. Qualifying disability trusts, I'll just touch this. A few years ago, the taxation of testamentary trusts, meaning trusts created by a will, was changed. Inter vivos trust set up while alive, income of that trust taxed in the hands of the trust instead of a beneficiary, which is where you want to put it, to have it taxed at a lesser rate. Taxed in the hands of the trust, every dollar is taxed at the top marginal rate of, in Ontario, 53.53%. Do you think that paying tax at 53.53 is reasonable for a trust set up for a child with disabilities? I don't think so. So when they brought in the changes that made testamentary trusts taxed at the same rate, it's just a tax grab, right? Now inter vivos plus testamentary are all taxed at the top rate on income declared in the hands of the trust. So of course you don't do that in one way or the other. But if the beneficiary of the trust, the testamentary trust, not inter vivos, that doesn't work. If the beneficiary of the testamentary trust qualifies for the disability tax credit, well then you can elect to make it a qualifying disability trust, in which case the income is taxed under the old regime at beginning marginal rates. 45,000 at 22%, 45,000 at 33, 45,000 at 44, which in the old days used to be good because you could have separate trusts, multiple trusts, each of which was a tax entity taxed at the lowest marginal rate on the first 45,000. And it was a very common procedure. Well, now you can't. Now you could grandfather, in a sense, a QDT if the beneficiary qualifies for the disability tax credit, but in most cases you wouldn't. And I've written a piece about this. If you want, there's a video and an article on Advocate Daily, because of course what you would do instead is if the benefit recipient qualifies for the disability tax credit, well then you can make use of what's called a preferred beneficiary election to attribute the income from the trust to the tax return for the beneficiary. And they have $20,000 of personal tax credits, and the next $45,000 of income is taxed at 22%. So you wouldn't normally elect to have a trust, a QDT, until you have in excess of $65,000 of trust income. Well, that's in excess of $1 million trust in most cases, right? So it's not a common scenario. So if you had multiple trusts and large trust funds, you might actually wind up making the QDT election, but in most cases you probably won't. But it depends, you know, you have to look at the scenario and see what's the best tax decision. As well, at the same time, what they did was they changed it. This was your Liberal government, by the way, guys, because there was complaints about foreign property buyers in Vancouver, which haven't affected me to a great deal. What they did was they changed it so that my clients can't set up an inter vivos trust, buy a condo for their child to live in, and have that property qualify for the principal residence capital gains tax exemption. Can't do that anymore. A testamentary trust after you're dead can buy a condo, child can live in it, it would qualify as a principal residence, but not while if you're making this transition while you're alive, and you're trying to get them set up and make sure they're okay, you know, and setting up an inter vivos trust before you die, you can no longer have that property qualify for the principal residence capital gains exemption, which is very unfortunate. There really should have been an exclusion or an exemption for my clients' children. So there should be a slide about insurance.
Next. This
Okay.
one?
So I just want to point out that a lot of times it's a very economical to have life insurance to fund or superfund the trust, especially when the child is over 18, because then if they're living with you, for example, they're bringing $11.69 into the household if we've got the benefits increased per month. And if you happen to be, for example, say you're a single mom and you're age 50 and you have a child with special needs, well, what this means is that you probably don't have a large estate. You might own a home, that could be. But, you know, if you've been a single mom for a few decades, and I think, you know, anecdotally, I think that divorce is more common to some extent. I don't have real numbers. More common in the families that have kids with disabilities. You know, there's a certain level of stress involved here for everybody concerned. Well, if you bought life insurance, 50-year-old female non-smoker, a universal life, that's the UL, of $100,000, the monthly premium would be $115 a month. So your child is bringing in $11.69, at least while they're living with you, a month. Plus you're using the disability and the caregiver credit, which is saving you $2,600 a year, which is just a little over $200 a month. And if you multiply that, you have an annual premium of $1,384. Now, if you're a female, and can you move the box down? The life expectancy is 35 years. Is it obscuring just me, or is that you?
The Q&A?
Okay, I don't know. Can you see the box? So you can see here the life expectancy is 35 years. Well, in fact, if you divide the annual premium into the 100,000, that would take you 72 years to save the premium in order to have 100,000? Well, clearly, if you're a 50-year-old female non-smoker, you're expected to live at least another 35 years and perhaps longer, but not 72 years. So if you decided that you wanted to buy life insurance, a fixed premium for life, this would be one way to top up the trust for your child and create an estate. And of course, the insurance would be designated directly to the trust. There's no waiting for probate. And if you happen to have a situation where you finally made that transition and the child is living semi-independently in an apartment or perhaps in a home, then you're supporting them on a monthly basis. You're helping to pay the bills. So, you know, it's helpful to have cash on a short-term basis. We say that probate would take 6 or 8 weeks, not the end of the world, but, you know, insurance pays roughly within 30 days. Are there any questions about life insurance funding trusts?
Let me bring the window back here. Not life insurance, but I have a question. About lifetime benefits trust. Is it something that most lawyers are familiar with? The bank had never heard of it when they brought it up.
No, it's just not very. I've been following it since 2003. The legislation finally received a final reading, royal assent in 2013. It's not well known. It just slid off the rails for a decade or so. And of course, you have to have a clientele that is large enough to have a sufficient number of clients who could use it to track it, to create the precedents, to explain it, to do the calculations. And I would say that, to be charitable, there's a limited number of lawyers that have a clientele as large as mine with this particular scenario to be able to warrant investing in this. That being said, you know, I'm just a humble estate solicitor, and ever so humble, probably the humblest you'll ever meet. But yeah, no doubt the humblest you'll ever meet. But that's a joke. But anyway, you have to have some reason to look into it and invest time in it. And you know, I have enough clients to do that. But you wouldn't expect that your average lawyer, let alone an estate solicitor, would invest the time into it.
I have a question here about Henson trusts. Paul is asking, is it possible for him to leave all or part of his estate to his siblings' existing Henson trust?
As long as he dies after, yeah.
After whoever has the Henson trust in their will?
Yeah, I mean, if it's your parents' will that's creating the Henson trust for your sibling, and what you want to do is to leave a certain amount on your death to that same trust, sure. And of course, we have scenarios where a grandparent wants to leave some money for their grandchild with autism, say, and they don't want to set up a Henson trust in their will to receive, let's say, $40,000, you know, a bequest. So we would provide them with the wording, and what you would do is you'd leave it, you know, to your child, the mother, let's say, and you'd have to look at first death family trusts to hold insurance and so on, but I'll try not to cloud the water here. What you would do is you'd leave the $40,000 to your child, the mother, but if they have predeceased you, to the trust for your grandchild, created by their last will. And so obviously, if your parent has predeceased you and set up a trust for your sister, and then you want to leave them something, yes, as long as it flows from a death, no problem.
Going back to pensions, someone is asking is it only disabled adult children who can qualify for the teacher pension when both parents pass away, or can a disabled grandchild also qualify? Like, could you leave your pension to the grandchild?
Well, I think you could, but they would, of course, have to be an adult dependent when you die. I mean, if you have a child and you die the child is under 18 or under 25 and still in school and so on, well then, there might be a child pension, but the issue is when they're an adult. So if you're talking a grandchild, would they be an adult? Well, they might be. And are they dependent? Now, to tell you the truth, I've never arranged such a pension. It's a logical question, obviously, such a pension for a grandchild. So we'd have to look into it further. But if I have situations, for example, where the grandchild is being raised by the grandparent.
Yeah.
So I suspect that in that scenario, I could make arrangements for them to be an adult dependent survivor. You see, it's not necessarily dependent on child, but to tell you the truth, I'd have to look into it further.
Yeah, okay. Okay. Wait, hold on. If life insurance is creditor proof and tax-free, why the need to put it directly into a trust? Can't the child have access to it?
If you want to leave life insurance to your child, go ahead. But of course, then they've got an asset, and if it's greater than 40,000, it's greater than the personal asset test, so it'll disqualify them.
Right.
If it's greater than 140, then we'll have to be creative to find a way to exempt it. Plus, are they capable of managing it? Are they going to acquire a lot of new friends?
Right. Can someone on ODSP or receiving or eligible for the disability tax credit have a TFSA?
They could have a TFSA as long as it's less than 40,000.
Okay. Yeah. That makes sense. Can a parent apply for ODSP for their child under 18 if they live with you, and would the parent collect it?
Well, there is no ODSP under 18. You could apply, if that's the question, 6 months before they're 18. There is ACSD, Assistance for Children with Severe Disabilities, under 18, but that's subject to household income. It would, in most cases, it would only be applicable to a single income household. It doesn't have to be a single parent household, just a single income. And there's a fair bit of that single income because mom's at home with the kid. And what it is, it's for it's like ODSP, but you have to. It's a maximum of $450 a month, and you have to show that there are things that the child needs, basically, that you can't afford. And you then have to get it approved, and you have to pay for them. It's like special services at home. You have to get approved, and then you have to pay for it, and then submit the bill and be reimbursed.
Herb is asking, can the TFSA as part of a seg fund then qualify up to 100,000?
They could, yeah.
Can
you just check the slides here? I want to see if I've got anything else haven't covered. No. Okay, that's fine. That's good. You can go back now, or leave it there. Yeah, that's good. Okay, sorry, carry on.
Can the trustee and the beneficiary of the Henson Trust be the same person?
No. It is possible now, pursuant to a Supreme Court case in BC, it's been settled that the beneficiary could be a co-trustee, but they couldn't be a sole trustee, because then, of course, they have access to the liquid asset to support themselves. Right? That's the problem. But they could be a co-trustee as long as they cannot themselves unilaterally access the fund.
Right.
We always presumed this was the case, but we never had to test it with ODSP. And now we have a Supreme Court BC case, Supreme Court of Canada case in BC, that determines that it indicates that the child, because in this case the child was a co-trustee, and it wasn't seen as disqualifying them from geared to income housing. So yes, they could be a co-trustee. Now, they couldn't act themselves and unilaterally, but the other trustee could have a very light hand. So I can see that there might be cases where this would be appropriate. I've never had such a case where it was seen to be the best thing, but it could be done.
Okay.
It's 8:45. I think we'll carry on. Are there any more questions coming up?
There's 13 and still more popping up for sure.
Okay, well, let's invest a little bit longer. It's our fault, we were late.
Yeah. Okay. Hold on. If RDSP has accumulated 40,000 or more, but hasn't met the 10-year withdrawal threshold yet, does this disqualify the child from ODSP?
No, the RDSPs are exempt for ODSP purposes, and all payments out of it after the child turns a certain age are also all exempt.
Gail is asking, I'm not sure I understand the question, but she's asking, are medical expenses like attendant or nursing care part of the allowable limits?
Disbursements for medical expenses, disability-related expenses, are above and beyond and exempt above and beyond the 10,000 over 12 months.
Perfect. Yvonne is saying, just to confirm, if he was on a defined pension plan like Omer's and he dies, the pension goes to his spouse. When his spouse dies, does the pension now go to the adult's dependent child?
That's correct. And the spouse would have been getting usually about 60% of the original pension, and the child gets 50% of the original pension. And unfortunately, as I said, it is often less than ODSP, which means that it simply offsets ODSP and does no good.
Okay, someone is asking, I am living in a house that is owned by my aunt and uncle. They live in an apartment elsewhere. If they leave me the house in their will, would there be taxes owing when they pass away? And is there a way to mitigate this?
Well, if they leave a principal residence, a home that they live in, to the Henson Trust, then of course there's no capital gains tax, so there's no taxes. And the testamentary trust could receive and hold a home for you. And if you lived in it going forward, then it would be deemed to be your principal residence, and it would be capital gains tax free as well. So it could be an extremely good thing to do. Now the problem, of course, is that you have to be able to carry the house. You have to pay all the expenses, not you, the trust. And you know, if a person's on ODSP and they're getting $11.69 a month, and if all they can realistically afford is $500, the shelter component, it costs, except in certain cases, Elliott Lake perhaps, or you know, used to be Dunnville, but now it's too close to Hamilton. You know, little places where the taxes are low, rural properties where, you know, you couldn't afford to carry it. So then it's a question of how much does a trust fund have, and can it afford to carry the property? But there certainly can be appropriate situations where it's clearly the best decision.
Okay. If the Henson trustee dies after the parent dies, does that trusteeship get passed on to someone else? What's the procedure?
Well, normally in the trust section, the trustee section, trustee appointment section of the will, if you can, you build in alternate trustees, obviously. And ultimately, you'd like to have a trustee who is the same age or younger than the beneficiary, your child. So in that case, you're often looking at siblings, obviously, or nieces, cousins, nieces and nephews. And failing that, Well, what we do is, because lots of people can't think that far, they just have no idea who that would be, is they appoint. What you do, my advice is, you make the best choices you can with the information you have today, right? Make your best choice right now, do that. As time goes by, you can make amendments, of course, to the trust arrangements. It's just a will, and nothing kicks in until you're dead, so nothing's locked in. But we put a provision that allows the last surviving trustee to replace themselves. So basically, you give that right, that authority to your trustee, who you have, of course, given an absolute and unfettered discretion to. Well, that reminds me, you have to go to that slide. And then we give them the power to pick somebody to replace themselves, which could be one of their children. Just for reference, these are the essential qualities of a Henson trust. They have to have absolute and unfettered discretion and a non-vesting provision, which means that the asset in the trust does not, in fact, belong to the child. Eventually, it vests in whoever is the residuary beneficiary when they die.
Someone is asking, how is my daughter going to manage the money in her RDSP when she has Down syndrome and I won't be alive by the time she's of age to receive it?
That's what the legal guardianship would be for. You would apply for legal guardianship for yourself and someone else, perhaps a sibling, perhaps a cousin, someone closer to her age. And then, you of course can manage this RDSP now as the account holder. So you don't really need legal guardianship, but you would have yourself and someone else appointed so that when you pass on, they can step forward and become the legal representative of your child with Down syndrome.
I am paying rent as a cost-sharing arrangement, so no taxes are owing. Can a rent receipt be provided to apply for the Ontario Trillium benefit?
No.
I had a similar question earlier about the Trillium benefit. Someone was asking if they are not going to claim the income of their child that's on ODSP on their taxes, does that disqualify their child from applying for the Trillium benefit?
It does.
Yeah.
Yeah, you have to bona fide pay rent. And of course, the Trillium benefit isn't that large. And they're not if they're receiving room and board, they're not getting it now.
Yeah.
Right? Nothing changes.
True. I am the legal guardian of my child. Do I need to appoint a legal guardian in the event of my death? And what is the procedure?
Well, you can't appoint anybody. The court appoints. So at the time of the application to appoint yourself, that person should have been joined in if you had that person at that time. And otherwise now it would be another application to add on the other legal guardian. And it'll be, slightly less difficult because, of course, you don't have to prove incapacity any further. You might well have to serve everybody who properly should be served to know who should be, told that this new guardian is coming forward. They may have some objection, but it's a new application to the court to have a new guardianship issued.
If an adult child is going to receive a teacher's pension, is there still a need for a Henson trust?
Yes, the Henson trust receives the estate. The pension is the child's pension. The pension is received directly by the child from teachers, right? But the Henson trust is set up to receive a share of the estate. Now, if you were to say, well, he's receiving the pension and that's all he needs, and you said, well, I'm not going to leave him any of the estate, well, okay, then you don't need a Henson trust. Something you should keep in mind, though, people often ask me, well, how much should I leave for my child? And short story is normally they leave an equal share, although sometimes it's disproportionate in favor of either the child with special needs or the other kids. And sometimes there's life insurance. that funds the trust aside from the estate. And of course, the child is going to have an RDSP in a lot of these cases at several $100,000, which the other child won't. But that being said, if you set up the Henson Trust, even if you overfund it because you're concerned, keep in mind that it's a very efficient vehicle tax-wise because you're making maximum use of the child's credits or the lowest tax rate. And when that child passes on some decades later, if the fund has in fact accumulated, it's probably accumulated in a very tax-efficient way, such as it owns a principal residence, tax-free. So the residual beneficiaries of the trust are typically the other siblings or their children, the grandchildren, nieces and nephews. So it's a very efficient process. And all you're doing is having an intergenerational transfer that's postponed. It's not like the money's lost. If you give some disproportionate amount to the trust for the kid with special needs, when they die, it all falls back into the family and goes to either their siblings or the grandchildren. So it's an extremely effective vehicle, and it's in no way lost.
Can an estate payment by someone in another country, like the States, be able to put into a Henson trust or another trust for a disabled child here in Canada?
Well, if what they mean is, can you contribute to one after, like this, similar to the siblings wanting to know if he could contribute to his parents' trust for his brother?
Right.
Yeah, you could certainly do that if that's the question. And if the question is, could you set up a Henson Trust in the U.S. for your brother in Toronto? Yes, you could. It would have to comply with the standard wording, of course. In the States, they do very much have special needs trusts. They're everywhere. They're governed by state statute rather than by common law. But you could certainly do a Henson Trust in the States. The only factor, of course, is that the beneficiary would be non-resident. The trust would be a U.S. resident trust, and the beneficiary would be Canadian, so non-resident. And even if all you give them is capital, you have to file a return and disclose the capital payments. There's quite heavy penalties if you don't disclose capital payments, even though there's no taxes owing. We did a trust, for example, for a mom in London, England, a little while back, and collaborated with her solicitors there. And she has a son in Ottawa who has disabilities, mental health issues. She and her second husband live in London, England, and her daughter and children, the grandchildren, live in London. So rather than try to, there are mechanisms where we could have set up a trust in Canada for the boy, but rather than do that, she had us incorporate Henson Trust provisions into her UK will, and she understands that her son is a non-resident beneficiary, but because her daughter is there and the daughter is the trustee, it just seems simpler all around. So yes, you can have non-resident trusts for children in Canada.
Okay.
We have about 4 minutes left before 9. I think that's long enough for everybody. If you submit your last questions, we'll see what we can do.
I mean, they're just coming in like by the second, really. We can't get to them all. There's like almost 50. We were down to 10, but now it's growing. I don't know.
That's a good problem to have.
Someone asked if the nursing pensions have the same ratios as the teachers.
No, hoop pensions don't have that.
Okay.
And neither do federal civil service.
Is there a way to avoid CPPD clawback when you're on ODSP?
Say that again.
Is there a way to avoid CPP disability clawback when you're on ODSP?
No, there's no way around it.
Okay.
It's a pension. I mean, it's a pension. It's income.
Yeah. Can I put my daughter's name on house deed?
I wouldn't.
Okay.
That's my advice. But you could leave it to the trust for her.
Right. My son has 2 Henson trusts. How will they be affected when he gets married?
Well, they won't be affected at all. That's part of the beauty of it. It's not part of his matrimonial estate. It's not attachable. It's not divisible. You have to bear in mind that the trustee has an absolute and unfettered discretion, and the asset is not vested in the child. So it's very good. For example, we use these as well where you have another child, there may be several children, one with special needs. So you set up a Henson trust for the one with special needs. And then it turns out that one of the other kids is a lawyer. He's a personal injury lawyer, and it does quite well, thanks. And of course, I'm in favor of that. And he's had a second marriage, and he's got 3 or 4 kids. And so if he receives his share of mom's estate, which isn't huge, but it's enough to think about, the income that it generates if it comes into his hands will be taxed in his hands, probably at the top marginal rate. So what you do is you set up a Henson trust for him, for his share. He's the trustee of his own trust, and he and his 4 children are the beneficiaries. So what he does is he attributes the income to his children, and they each have a $12,000 personal tax credit. So instead of having income of, let's say, $20,000 a year from the trust, or personally, and paying tax of $10,000 a year at the top rate, in fact, what you have is trust income of $20,000. You split it between 2 of the kids. They each have a $12,000 credit. So they each have a $10,000 income. You pay no tax. And the $10,000 you don't pay in tax, you use to fund RDSPs for the children. And then, if you divorce again, the story is slightly more complicated than this answer, but if you divorce again, the trust asset is not divisible with the spouse. In a normal case, here I'll show you. In a normal case, you see that?
A little bit, yeah.
Can you see what it says?
Discretionary trusts can be problematic.
Yeah, I see that. Well, it's true. Discretionary trusts can be problematic. If all you have is a discretionary trust that was set up, not a Henson trust, an absolute discretionary trust with a non-vesting provision, then of course all it is a trust in which you have a beneficial interest. And so of course, most family law judges would take into account that you have received this sum of money from your parents who worked hard and were frugal and didn't spend it and didn't waste it, in order to leave it to you so you could help provide for their grandchildren. Of course, that was how that actually works. And then, granted, the will had a community of property clause that indicates that you're supposed to keep it separate and identifiable. And in that event, only the growth on it is supposed to be divisible with your spouse when you divorce, got all that, right? But the judge doesn't really care, right? He winds up giving the other spouse, the divorcing spouse, a disproportionate share of the principal residence, the matrimonial home, to acknowledge the fact that you have more, even though it's not really yours. It's the money that your parents saved to give to you to try to help you provide for your children. So it's obviously completely inequitable and unfair. It just happens to be part of family law and depends on what the judge had for breakfast that morning, whether he argued with his wife that morning or whether she argued with her husband, right? It's just completely subjective, although of course it's couched in words that try to make it look legal and fair in some way. That's my rant for the day.
Mm-hmm. All right, I guess we should wrap it up. I feel like
it's low after 9 o'clock. I guess if I start to rant, it's probably about time to quit, eh?
Yeah.
All right. Well, thank you, everyone. I hope you found this enlightening or interesting or useful. Feel free to send questions to me later if you wish. We will be posting the video on YouTube and sending the link, and we will be sending the PowerPoint slides. And thank you for taking part.